What if I told you that a crisis brewing quietly in Japan isn't just about their colossal public debt,
Right.
but that it's actively shaking the very foundations of U.S. financial
It
markets?
sounds like completely counterintuitive, doesn't it? I mean, we've all seen the
The
headlines.
year.
Japan's debt-to-GDP ratio. What is it now? Something like 230%. It's an unbelievable number.
Mm-hmm.
And the world's just kind of treated it as this, a theoretical problem.
They can just manage forever.
Exactly. But the source material for this deep dive shows that the real immediate crisis, the thing that actually forced their hand, is a fight against domestic inflation.
And that's the pivot, the key pivot. Japan is in this urgent scramble to fight inflation and, maybe more importantly, to save the value of the yen. And this move by the Bank of Japan, the BOJ, it's not just some regional story. It is directly, and I mean powerfully, hitting global bond markets.
What we're seeing is the start of a massive capital flow reversal.
And it's crushing the demand side for US Treasuries.
That's it. This is why this is so critical for you to understand. It explains why the cost of borrowing, why the stability of the entire financial system is changing so fast.
That decades-long pattern of the US just absorbing massive inflows of foreign money.
That pattern is suddenly under threat.
Yeah.
We really need to dig into the mechanics of why that faucet is being shut off.
Okay, so let's unpack that. Let's start with the domestic pressures. You said inflation is the fire they have to put out. Why now? Why is that the priority over this debt monster we always hear about?
It's a really vicious trap, and it's one that a lot of outside observers miss. Inflation in Japan has been running near 3%.
Which is way over their 2% target.
Comfortably over. But here's where it gets devastating. You have to look at the wages. Wage growth is just lagging so far behind, tracking at only 1.9%.
So wait, the average person in Japan is earning a tiny bit more,
A tiny bit.
but their actual purchasing power is going down every single month.
Precisely. They are getting poorer in real terms. And if that keeps going, you get a catastrophic feedback loop. People stop spending, consumption collapses, and the whole domestic economy just seizes up.
And that's why the government had to act.
They had to, before the whole engine just stalled out.
What's really wild to me, though, is the conflict in their policy. I mean, all those concerns about the 230% debt to GDP, they've just gone out the window.
Seemingly, yeah.
Because they're about to drop a massive stimulus package, right? Something like $120 billion. A lot of it from money printing.
And that's the technical contradiction. It just shows you how desperate the situation is. On one hand, yes, you have to help consumers with rising prices.
But on the other,
You're injecting huge amounts of liquidity. I mean, $120 billion is 3.4% of their entire GDP.
which normally just fuels more inflation.
They're fighting two fires at once. But the real priority is clearly saving the yen, because a weak currency is just pouring gasoline on all their other problems.
Okay, so explain that. Why is a collapsing yen an existential threat for Japan? I thought a weak currency was good for exporters.
And normally, it is. It makes your Toyotas cheaper abroad. But this isn't a normal situation. The crisis is being driven by imports.
They're an island nation.
An island nation with extreme reliance on the rest of the world for resources. They import 90% of their total energy needs. Just think about that.
Like 90%.
We're talking nearly 100% of their oil, 97% of their natural gas, 100% of their coal.
And the crucial piece there is that all of that is priced in one currency.
US dollars. Globally. So when the yen gets weaker, they need way more of their local currency to buy the exact same barrel of oil.
So it makes everything more expensive.
Prohibitively expensive. It crushes consumers paying for electricity, but it also crushes those export industries you mentioned. If the cost of your energy doubles because of the currency, it doesn't matter if your final product is slightly cheaper.
Your profit margins get wiped out.
Completely. For everyone from Toyota and Honda down to the small anime studios, their cost of just keeping the lights on is spiraling.
So that external pressure forces the central bank's hand. And this is where it gets really interesting for the global market. The BOJ gave what the sources are calling the strongest possible hint.
A verbal commitment, really.
That a December rate hike is coming. They are choosing currency strength over everything else.
And that signal? It sent immediate shockwaves, not just in Tokyo, but across the entire global bond market. This was the BOJ shouting to the world, the era of zero yield is over, we're calling our money back.
And you can see it in the data. I mean, the effect on Japanese government bonds, the JGBs, was immediate and dramatic.
Oh, the moves are historic. The 10-year JGB, their benchmark, surged to 1.84%.
And to put that in perspective for everyone.
That's a level we last saw during the absolute peak of the 2008 financial crisis.
Wow.
The 20-year yield is almost at 2.9%. That's a high they haven't seen since 1998. And even the short-term 2-year bond crossed 1%. Again, back to GFC levels.
This matters because for decades, these bonds were yielding basically nothing. Zero. They were not competitive.
Not at all. And that's why this pivot is so critical.
Mm-hmm.
It means that for the first time in a generation, Japanese bonds are actively competing with US Treasuries.
Before this, Japanese banks, pension funds, they had no choice. They had to send their money overseas to get any kind of return.
Mostly into US assets.
Mm-hmm.
Now the BOJ is saying, hey, you can get a return right here at home. And that is competition the US cannot afford right now.
And let's talk about the scale here, because this isn't a small amount of money we're talking about.
No, not at all.
Japanese investors, right behind the Chinese, are some of the biggest pools of capital in the world. The sources estimate they have nearly $5 trillion invested abroad.
5 trillion. That is the reservoir of liquidity that has been propping up the West, especially the US Treasury market.
And the unwind, it's already started.
It has. The data from 2024 is really clear. In just the first 8 months, Japanese investors bought 28 trillion yen worth of their own JGBs. The money is heading home.
While at the same time, they cut their purchases of foreign bonds, including US Treasuries, by 50%.
A 50% cut. The new money isn't leaving, and some of the old money is coming back.
And that brings us to the real core of this crisis, which isn't just about yield, it's about currency risk.
That's the key. If the yen strengthens significantly, and some analysts like Morgan Stanley are forecasting a big repricing.
What do they say?
Potentially from 150 yen to the dollar down to 140. If that happens, Japanese investors literally lose money just by staying in dollar assets, even if the U.S. yield looks higher on paper.
Okay, walk us through that math slowly, because this is the most important part of the whole analysis. If you can get 4% on a U.S. Treasury, why on earth would you take a Japanese bond at, say, 2%?
It all comes down to your total return when you convert it back to your home currency, back into yen.
Right.
So let's just run a simple scenario. A Japanese pension fund holds a U.S. bond. It yields a nice, safe 4%. But over that same year, because the BOJ is hiking rates and the U.S. Fed is cutting, the yen gets, say, 6% stronger against the dollar.
The dollar gets weaker.
Exactly. When that Japanese fund goes to cash out, when they convert their dollars back into yen, they lose 6% just on the exchange rate.
So they earned 4% interest.
But lost 6% on the currency. Their net loss for holding that safe U.S. asset is 2%.
Wow, I see. In that scenario, they actually lost money.
They would have been better off staying home. By taking that 2% yield on a Japanese bond, they get the income. And crucially, they have zero currency risk.
2% with safety beats a negative 2% with massive risk.
Every single time, especially for conservative investors like pension funds.
And we don't even have to guess. There's a real-world warning about this exact risk. That disaster back in May with Norin, Japan's big farmers bank.
Oh, yes. Norik. They were hugely exposed to U.S. Treasuries and lost an incredible $12 billion when bond values fell.
They were forced to just dump assets.
That event sent shivers through every financial institution in Japan. And now, the incentives are completely flipped. The risk of staying in dollar assets is it's escalated dramatically. I don't think they'll make that same mistake twice.
Which brings us right to the consequences for the U.S. And the timing here is just horrible.
Yeah, the worst possible timing.
The sources are all suggesting the U.S. Fed is moving toward rate cuts. They need to help corporations refinance, to paper over deficits.
Right.
And they're doing it just as Japan is hiking. This is a perfect storm for U.S. asset values because a huge essential buyer is just vanishing.
The U.S. is facing this dual crisis.
Yeah.
Domestically, companies that borrowed a ton when rates were zero are getting crushed. They need the Fed to cut.
But if the Fed does cut and Japan hikes,
the incentive for any global investor to hold U.S. debt just evaporates even faster.
There's even a really fascinating political angle in the sources. A claim that a former administration official, a guy named Besson, may have actually wanted Japan to strengthen the yen.
To kind of stabilize things.
Right. The idea was to avoid a chaotic, complete dump of U.S. Treasuries.
But that's the law of unintended consequences. Whether it was intentional or not, the market reaction is now spiraling. It's not a stabilization. It's an active withdrawal of capital that's threatening U.S. markets.
And this matters so much because the U.S. needs to borrow staggering amounts of money, not just for deficits, but for new infrastructure. Look at the numbers for just one sector, AI.
It's astronomical. We're looking at $1.5 trillion.
$1.5 trillion just for data centers over the next 5 years.
That figure alone is about 20% of the entire investment-grade bond market that needs to be issued over that time.
The whole U.S. economy is built on this assumption of cheap, reliable capital flowing in. If Japan, a key buyer, pulls back, what happens to that trillion-dollar investment in AI?
The cost of borrowing for the U.S. goes up dramatically. When a massive buyer disappears, yields have to rise to attract new money.
And if borrowing costs for these giant AI projects climb?
The projects become unprofitable. The whole investment thesis for AI, which is based on cheap financing and future scale, it gets threatened. The future of AI is literally tied to this Japanese capital reversal.
Okay, so let's synthesize this. The core dynamic of global finance has shifted. We have a world swimming in bonds, and you have this divergence.
Right.
The dollar is likely to get weaker because the U.S. is cutting rates, while the yen gets stronger because Japan is hiking. And that just makes U.S. debt suddenly very unattractive.
And investors are already placing their bets. They're buying Japanese bonds now, driving up demand because they expect the yen to rise. It's a fundamental change in how global assets are being allocated.
So that's the bottom line. If the BOJ hikes and the yen strengthens, a big exodus of money is going to leave the West. It starts with that $5 trillion from Japanese investors.
And it could easily be followed by Western money trying to get out of a collapsing dollar. This isn't just a market fluctuation. It's a systemic shift in financial gravity, away from U.S. dominance.
It's the end of an era.
It truly is. The end of an era of effortless U.S. debt financing powered by Asian capital. That era is over.
So here's a final thought for you to take away. If this currency reversal continues, how far can the global financial system really decouple from the U.S. dollar? And what other unexpected places might benefit from this sudden, desperate search for alternative places to put money?
Something to watch very closely. The evidence is clear, the conditions have changed, and these dynamics are playing out much faster than I think anyone predicted.
Yeah.
You have to watch the yen.